Welcome to the weekly YouTube show. It's been a minute, hasn't it, guys? We had last week the Ultimate Traders Summit. How many of you guys were at the summit? I have to say it was a spectacular 3 days. And I don't just say that because it was a TradeSmart event. It seriously is my favorite trading event that I have ever been to or been a part of. If you miss the Ultimate Trader Summit, you lose. No, actually, there was a lot of popular demand to consider reteaching that in the fall. So if you did miss out, the message got out a little bit late for people to get 3 days off from work and childcare and all the things. So we are considering, not promising, but considering doing the Ultimate Traders Summit again. It was an absolute blast. I appreciated Scott being there, sharing his wisdom and knowledge on pitchfork analysis. Everybody's mind was like just reaffirming Scott's genius in the industry. And Chris Burgess was unfortunately traveling, so maybe in the fall, if we do it, we can have the one, the only Chris Burgess share a little bit as well. The week prior to that, we had some technical difficulties, so it's actually been a little minute since we've been together on the weekly YouTube show. I've got with me the one, the only Stocklanders, and of course, Chris Burgess, our faithful friend and sidekick in the stock market. I'm so grateful to be together with these men and talk trading things. Our outcome today, our topic of the day is going to be dealing with wildly overbought and oversold markets. And I'm gonna just steal the mic and kick us off. Everybody's like, shocker there. But hey, when you're in control, you're in control. And for those of you that were at the trading summit and even leading up to the trading summit, when I did the IPO, the TradeSmart IPO indicators, trading plans, and options, I was taking a very close look at this particular indicator right here, the MACD indicator, the Mac Daddy of them all. And we were talking way back, right about at this peak here, we said, MACD has never been this high before. Now it's a uncontained indicator, meaning it can go as high as it wants. But I think even the COVID bounce, let me see, we were at 9.32 and up here we got to, yeah. So we hit new highs on the MACD. And, you know, so much of stock trading, it just does not take a rocket scientist to figure out if you kind of hover over each time MACD got overextended, price action pulls back, because what MACD is literally showing you is the relationship between two moving averages on the chart. And when they get wide apart, which drives the MACD way up or way down, then it becomes unsustainable. It's a rocket ship, and it cannot hold its trajectory without having some kind of impetus or momentum that's added to that equation. So just hovering over some of these MACD peaks here, you can see that when MACD gets overextended, it pulls back. And so when MACD gets the most extended that it's ever been, outside of any kind of a pandemic that hit when MACD got ridiculously oversold, but just the normal ebbs and flows of the market, we were taking a close look at this indicator and we said, that is a big old problem. And so in many ways, we top ticked the market right here, looking at resistance, looking at the MACD overextended. And I've been in a bearish position, and I just closed it yesterday in full disclosure, candidly, because I was thinking, I don't know that this can get much more overextended on the bearish side than it is without a little bit of a bounce. And I'm still thinking that bounce could come. This green box is my Fibonacci zone. Of course, we'll get opinions from Scott and from Chris on this. But in essence, there is my, let's actually drill that down a little bit closer. Well, for round numbers right now, that's about what we were looking at. There you go, bottom of the gap. About what we were looking at in the Ultimate Trader Summit when we were doing some analysis and work with fibs. We were taking a look at this as being a possible pullback, which is actually one of the reasons I've opened up a few bullish positions, not necessarily long-term bullish, but I'm thinking that a little bit of a rebound is possible and maybe even probable. I may change those after we get Scott's opinion today on the market, because he's like a stock market prophet. I think you can say that. It's like a stock market prophet when you're talking to Scott. So anyway, that's my big perspective from what's happened in the past. Then, of course, if we come over and look at current events, stochastic being way oversold. Not that it can't stay there in a bearish market, but we are way down. I don't know that I've seen stochastic down around 3 or even under 3 a whole lot. And we're not going to get into all the ebbs and flows of what makes stochastic work, but just zooming out a little bit here, you can see my cursor is hovering over it. Only maybe one other time right around in here that stochastic got that oversold, and we saw a little bit of a bounce. Big picture, and I don't have my tablet running. Let me see if I can do that super cool here without anybody realizing I'm doing it. Big picture, I have one other concern that I'm just going to throw out as a grenade into the conversation here. And to my untrained little eye, I spy a head and shoulders pattern coming into resistance. Now it's a little complex here because typically head and shoulders patterns happen at the end of an uptrend. And so we saw these head and shoulders patterns. Y'all remember when we were talking about this, I see dead people. I see head and shoulders patterns everywhere. And that, of course, sent us into the 2022 bear market with an expectation that there was a retesting of the neckline, and then we took off. You know, we could slice this a few different ways here. Yes, and amen. We're in a bearish trend until proven otherwise. I would see this right now as a leg up in this otherwise confirmed bearish downtrend. So technically we don't see bearish head and shoulders patterns when we're already in a bearish trend, but this was a pretty aggressive move from July, bringing us back up to old points of support, which are now resistance. And I don't think it goes unnoticed, the pattern at least, that we're seeing a bearish head and shoulders pattern when the market was wildly overbought and we're heading on back down. So my hallucination, and then we'll get Scott to set us all straight here. But my hallucination is there's a likelihood we could bounce on this fib, and whether we're testing a neckline of a head and shoulders pattern that we head down to, or this itself is just a retracement in a new developing bullish trend, I don't know. But I think that the amount that we're oversold, how far and how fast we went, is it should be a little bit of a yellow light for those who are in bearish trades. You might want to take some profit off the table and avoid jumping into some new bullish trades. So I'm gonna, I don't know, do you guys have a preference who, I mean, y'all can argue. It's more fun for the audience when y'all argue with me, but I'm just afraid Scott's gonna say stuff and then nobody's gonna want to say anything more. So maybe you should go next, Chris.
Set him straight, Scott.
Go, Chris. Go. Get him. Sorties wants his beard back, so.
Oh, the beard's coming back. Hold on. Let me see if we
She and I both.
Look
Sorties didn't miss it. I'm just gonna let you know. Sorties already commented.
In fact, I misjudged, candidly, if we could just confess for a second. I forgot about the trading show because it had been 2 weeks since we did it. So I was thinking when the Ultimate Trading Summit finished, I was like, oh, you know what? I've got about a week until I've got to be on camera again. We can grow the beard out in all its glory, and you won't go through the scruffy phase. And I forgot about the show. So old Eagle Eye Sorties, she caught it. So 1 million bonus points to Sorties for that.
Chris, do something with him.
I don't have a whole lot of any, I don't have a counter argument for your analysis or anything. I think we're pretty much all seeing the same thing. The only thing that I like to caution people in situations like this is something you mentioned also, Josh, which is that just because it's oversold doesn't mean it can't get more oversold. Mm-hmm. So that being said, I'm definitely I've got my finger on the trigger. I've got some bullish trades that I'm excited to put on, but I'm not doing it yet until we start to see the bounce, especially after we had that gap this morning. We just have to wait and see what happens. So,
Chris, anything that's made you uncomfortable lately with the market? Anything that just seems a little more extreme in your head than anything else, or you or Josh? But since you've got the mic right now, is anything just catching you different than you expected or thought currently?
I didn't think we'd see such an extreme reaction to the Fed announcement. The fact that it just kept going that day and then basically hasn't let up since then. When I saw the actual announcement, I was like, okay, that's obviously not going to be good for equities, but it does seem like there's been a lot of pent up selling that has finally been released. That's what it seems like to me. And we've gone down very sharply. I know you like to talk about slope a lot, and I would bet this is one of your unsustainable slopes here.
It is. It really is. I'll show my screen. So I will do my best to not go on and on about this, but y'all know how I feel about slope. And if whether you're in traction or traction pro, they've been lit up pretty hard about all this lately, not in the negative, but just so you guys have seen this in prior YouTube videos. I've showed this, and this is its parallel. You got a 3-wave count up here. We talked about the retracement of this, and I'm just, again, all this is documented out, guys. So none of this is in hindsight, like I'm coming at it that way. But even with this right here, come on, Petrol Station. The expectation of this leg was half, and we've gotten that a little bit more. So it's when you get extreme slopes, you really want to look for half to keep it super simple. So I'm going to go back to this. I'm going to show you guys a couple of things with this, and everybody's listening. So we're clearly trying to trade back into this preceding magenta channel. At the same point in time, you're hitting the arc, and at the same point in time, you're hitting that sand line that I've posted a lot over the, I don't know, previous months. So you're getting that point of support. You've had at least a 50, +% retrace, whatever you want to call it. So you're getting that zone of support. As Josh has pointed out, we were kind of communicating earlier about extreme markets. The slope is unsustainable. So if that's the case, say don't catch a falling knife, right? I know everybody's heard that, but I want you guys to think through this logically for just a minute in your heads. If something is still falling, right, and the energy is still coming down, and you're trying to buy it, right, as it's coming down, you're waiting for the trampoline to reverse the energy to push up against you again, right? And so that's where the opposing force, opposing slope, opposing angles, opposing energy comes into play here, right? Ideally, in an ideal world, next week, maybe we gap down, flush out, maybe open higher, flush down, whatever. And over the next couple of weeks, the next 15 to 21 days, give or take, 2.5, 3 weeks, something like that, this does set up. With me saying that, Josh hit on this a minute ago, and Chris has touched on as well. There is this, everyone wants to get, we want to buy long, we want to play trade, short-term trades. The question always surfaced to everyone, is it a trade or is it a trend? And let me nuance this for a second. It's a simple question. Is it a base hit or is it a grand slam? Do you really think that if you buy it right here, right now, again, I'm not passing judgment with me or anybody else in our thought process. I'm teaching you this forever and ever, whether you day trade or you're investing. Is what you're looking at something that's setting up that you think is a base hit, or is it going to be a home run grand slam? Do you think it's going to become a trend? If not, it's probably just a trade. And really good trends have certain characteristics. Now, we're not going to spend the hour going through that. I know that. But I'm trying to force people, because what I observe over 2 decades of working with traders is this same behavior. People come in, they don't understand slope, they don't understand what's sustainable, what's unsustainable, and they want to buy something thinking that it's going to go vertically back up, which is pretty rare. On top of which, we've just wrapped up August. We're going to 2 of the statistically weakest months of the year. You've had the junior varsity, or as Raymond and I joke about, the cheerleaders on the field playing because everybody's on vacation that matters to Wall Street. And so the JV's on the field playing the game right now. And every summer, this is the way it plays out till after Labor Day. We get through Labor Day, and the pros come back in from their long, illustrious vacations up in the Hamptons or wherever they're going to hang out. And then they start to go to work. There is a reason the 9th month of the year is significant, both mathematically, numerologically, planetarily. And so we're going into that time frame. So I guess for me, looking at the behavior of what's happened in the market, I'm not really surprised. The arc here, if you imagine taking an arc of that right there, it's unsustainable against the slope. So now the pullback against it is just as unsustainable, unless you're going to crash the market. And I mean black swan or massive crash. You're also trying to trade back into prior channels, and that's a no-no. And so when that happens, especially on steep slopes, guys, it wants to come back out of it. You've got to differentiate in your head, though. I'm on a weekly chart. One more chart here, and I'll get off the mic for a sec and let you guys get back on. Here's the monthly. Okay. So our tipping point through the traction group was where you see that, I don't know, 419, 41680, whatever it was, 41680 we're looking at in the real time. And there's a way we get to this. Now we're back to prior supports. These are all based off simple logic that anybody could go figure out. So we've had not only 3 waves up on your weeklies, but then you have 1, 2, 3 waves down on your monthly. 5 waves up, 3 waves down, 3 waves up, and then we're coming back down. Lots of basic pattern structures. Are you overextended? Sure, you're overextended. The only question is, are we going to get that flush? And this market dive has been quite orderly when you drill down to smaller time frames. So I'm trying to cover market structure while also trying to address the scenario of what the market's in, the conditional state it's in, which brings me to this. If in doubt, no trade's a position, right? If you're not comfortable, if you can't frame it and understand it, don't trade it. It's really, I try to keep it that simple. One more point. UVXY, the triple inverse for VIX, right? It's not in panic stage. As we go into this month, I would need to deal with around the 1350s, and I would have to get follow through the 1350s for that to really matter to me right now. At a minimum, 15 would be a lot more interesting. My minimum threshold for fear in the market would be 1350-ish, give or take. And I still got to close through and fall through on top of that. We're not there. So I don't look at what's happening in the market as anything that is super panicky at this point. That's just from my own work and research that I do. So does that questions help shed some light, or do I need to add more to that? Josh, save me here.
Save me. I don't know. That's only Jesus can do that. But so from your perspective, this is, until we get different information, this would be a retracement in a new bullish trend, is how your framework still is setting up. I know you don't use the B words.
So I got asked by one of the fund managers about what I think about the current environment. I think we're range bound. That is more so to me. I'm looking at shorter term plays, just like you mentioned, and Chris mentioned, like you're trying to load the boat for opportunities. You're going to have some snapbacks, but in the bigger macro picture, I need more time to make a decisive decision on what I think in the bigger macro play. And are you at a point we're getting oversold? Yeah. But my version of oversold and somebody else's, I'll just use me and Josh in this case. My expectancy from oversold, how close am I to really getting into oversold, the point that I want to put the position on? I might be trying to go to a zero turn point again. Josh is happy to get in a zone. Guys, that is not a criticism myself or Josh. When I say that, it's a perspective of how we look at things and then my expectancy of the bounce from that. So yeah, and if I'm short, have I had a reason to exit? Not according to things I teach, no. Targets, yes, but have I had a key reversal signal? No. I'll go back to the start of the conversation to try to help you some light on this. If we're still going lower, we can't be going higher. Just like a seesaw, if the weight's going down, it can't be going up, right? But what we're looking for is a longer term structure to pick up that slows that momentum down so it can then turn. And the slopes are unsustainable. You're trying to trade 90 degrees left of the current trend. It's not sustainable. Doesn't matter if it's Warren Buffett, Ray Dalio, whoever it is, anybody. You at some point, you got to stop going lower. I know this is common sense, but what I see is what we know and what we do as traders are two different things when I work with traders. So if we're still going lower and we're still trending lower, still expanding the range, then how are we going higher? You mathematically can't be doing both. It's impossible, right? So we need to see that momentum slow. We need to see the energy start to consolidate. If you're an aggressive trader, and again, this is all based on personalities in here, okay? This listening to us, or so even between us. If you're aggressive, heck yeah, there's been opportunities to trade. There were opportunities to trade long this morning. Right out of the gate, there was opportunities. But from a more macro, tangible, longer term, for me to get a feel of the further 90 days out that I'm going to look for the next macro trend, I need more data right now. So right now, I'm just looking at the zone that we're in between these two white lines on the screen, a bunch of unfilled gaps that need to get filled, and we manage it from there. So that's just where I am currently. Another day or two, next week, I may change my opinion about that, just depending on how the data plays out. But so as opposed to, for right now, everything I look at is just a trade opportunity. If I'm in this downtrend, I'm managing the trend. I'm maximizing the trades into whatever levels, but I do not have on a 60-minute time frame at the most basic level. I don't have a reversal signal to the long side as we're talking right now at 11:20 Central. Like, that sounds, but when I'm asked by fund managers, like, what do you think? If I say I need more data, they respect it. I just need more time. But if we're in a trend direction, I'm going to manage that trend I'm in. And until I have a key reversal signal, I don't have it. So I know that's a lot, guys, but I don't want somebody to ever take what we say and just run with it, that Scott's just blanket bullish or bearish. This just, hate to thread a needle that way, but people react to what we say sometimes. I'm mindful of that.
So it's a good distinction, trade versus trend. And I think, I mean, who knows who's in the YouTube sphere? If you're in our group coaching call here on Zoom, I think a lot of people that come through Trade Smart are traders. And that's not to say you shouldn't keep trends in mind. And I do think here in the next 6 months or so, just statistically speaking, you're going to see a bottom in the market. You're going to see stocks that are on sale, and you've got an opportunity to start loading up on some longer term positions and doing more creative plays like Chris does with covered calls and other advanced option strategies to play against those. But one of the things that I'm looking at, I'm going to take back the screen here. Yep. I can steal it from you. I have the power. You guys see the chart now?
Yep.
We're sharing the screen. Okay. You know, again, the way that my framework and my thinking works is really predominantly Fibonacci based. And so, and I'm not going to pull up the slides, although I have some really great looking slides that would be amazing here. But if we're measuring starting from this gap, and if you want to know why I picked these crazy candlesticks, it's all very intentional, not accidental. That's a different course. But basically what we're saying is, as long as we trade to or within, but not below this green box, then I have to maintain a bullish framework, because we've already exceeded the previous bearish framework in a short-term context. And so at this point here, and the reason for some bullish positions today, one bullish position to be specific, is using position sizing. I'm willing to risk 2% of my account, which if we get stopped out, which my stop is down here, it's this fib, you know, below the box. If we get stopped out, then I lose 2% of my account, versus if we come up here to target, and I'll show you how we're targeting in a second, then I'll get 1 or 2 R, which would be 2 to 4% of my account back. And so then it becomes, for me, an exercise in probability. What is the likelihood that we're going to just keep coming on down, as oversold as all of the indications are by any measurement, and we're sitting at my Fibonacci pivot point? What's the likelihood that we just keep on coming down versus coming up and hitting a quick target before maybe continuing on down? So then the inverse to this is too many things on my desk here. Why aren't you working, mouse? If we were to come down, let's just say that today was the bottom. I'm going to use the gap. I mean, it's a big if, but we could put another box up here, and we could say the exact same thing that we just did from a bearish perspective. And we must say, with this framework in mind, as long as we trade to or within, but not beyond this red box, then we could come on back down and continue lower. My current estimation, I don't want to call it the bet because that conjures up the wrong practice, but my estimation is that before we would get to my stop down here, there's a good chance that we'll come up to this red box. Whether we blast through that or not, I don't know. I'll be exiting my position at that red box. Candidly, it's hard. I know we've said for a long time that this is not 2007, and that's still my story. I'm sticking to it. Let me see if this is still, no, it's not. Go back here. I'm just going to throw some fuel on this thing for 1 second here. by the way, if you're at the trading summit, it's pretty cool. We went back and found the exact candlestick pattern in 2008 that I discovered when the market really started selling off, and that was God's favor on my life, because I saw that and started buying puts in early 2008. It's called a falling three pattern. It was cool to go back and kind of trade in real time through that and see that showing up. But here's the head and shoulder pattern that showed up in 2007. The market sold off. We came back. We top ticked on the 200 period simple moving average. And I just want to kind of play out for you where this went from here, because there was a lot of people, as we started selling off, which, by the way, this would kind of be the version of where we're at right now. We got way oversold here. We had a little bounce up. You could imagine me back in 2007 with my 3 friends that I had at the time, drawing a little Fibonacci box there and trade to or within, but not above. And then it came on down. Let's just kind of play this out in real time here. To Chris's point, just because it's oversold doesn't mean it can't become more oversold. And this, of course, was the bottom in 2009. So just take a mental snapshot, or heck, take a real snapshot if you want, of this picture right there. Right there, exactly. And tell me if it's maybe a second verse, same as the first, doesn't feel a little bit like that picture right there. The situation is completely different, but the pattern is the same right now. And I don't think with that we can keep ignoring that forever. 2007, it was housing market collapse, the US economy collapsing, and we had the Black Swan event. 2022, it's supply chain issues, COVID, all the things. But guess what? Have you all been researching China? China is going through their version of 2007, 2008 right now. They are experiencing that real estate market collapse. Research, like literally economists are saying this is that. And so maybe it's not happening on US soil, but it is happening over on Chinese soil. And again, head and shoulders pattern came off. We top ticked the 200 period simple moving average. To me, and I'll answer the question Scott didn't ask me, what was surprising? I was surprised how definitively the market rejected that 200 daily moving average. Almost to the point. And just as we were starting to get positive news, triggered by the Fed, obviously driving it down so far so fast is interesting to me. So my big picture thinking, I wish I could draw. I can't draw that. No, it's going to look like a bad picture. I'm not going to finish that. I wish I could draw a light bulb. My big picture thinking here is, and even already, of course, I'm going to give my own adage, don't predict candles before they close, but a little bit of a hammer out of Fibonacci support. I see short term, a little bounce up into this Fibonacci area, but then I see some challenges for the market. The other thing, and then I'll stop talking and let Scott go. If you were in the Ultimate Trading Summit, this was so fascinating. It played out in real time. This pattern right here, you've got to get a little squinty-eyed like that. You got to get a little squinty-eyed, but by golly, that is very close to a falling three pattern, which is the exact pattern that I saw in 2008. I'll show you where it is. I think I can find it again. And in fact, I think if we look at this on SPX as opposed to SPY, yeah, even a little bit more so. It's not textbook, so don't send me hate mail. If you do, send it to Chris Burgess at tradesmartu.com. But technically these 3 candles should all be within the body of this first candle. But again, if you get a little squinty-eyed, I think the sentiment is there where we had a significant move down. This is called a combo candle. Steve Nissen taught that himself. And then we had, an attempt to come back up. And then there's Fed Day, a definitive move on down. Y'all, if this is a real falling three pattern here, this is about as close to that as they come. I'll show you the one just because it feels cool to go down memory lane. I'll see if I can show you the one where I saw it was September. There, I even flagged it. Look at that. I reminded myself where it's at. No, that can't be it. Yes, here it is. It seems insignificant now, but that was the bona fide falling three pattern right there. And again, maybe it was God's favor. Maybe, this is a 1 in a million shot, but I saw that pattern. I saw the head and shoulders. This is my story. That's where I started buying puts right here. Not because I knew, like, this is before TradeSmart, before all that. Somebody told me they had taught me about options recently. And then, oops, son of a gun. Go away. I don't even know what you are. Go away, radial menu. Then, of course, the market just cratered into 2009 right there. So I think, and I'll toss the microphone back and see what you guys think. I feel like it's too uncanny that we cannot keep ignoring what that pattern looked like just a decade ago, really.
So can you hang on? A couple of things here. Chris, you want to jump in? Go ahead. So
yeah, I was curious, Josh, if you knew or if you remember what your approach was to buying puts at that time. Were you
terrible? Even
buying more
if I
longer
knew
term
it,
stuff? Were you buying short term and rolling them forward as they were working, or what?
No, they were shorter term and rolling them forward. I would not trade my own strategy that I did. It was risky and foolish and all the wrong things. Like it was luck back then, and it bit me when the market V bottomed in 2009. Luckily, because I was broke and I was pulling money out of the market just about as fast as I was making it, it didn't have a catastrophic effect, because it would have. If I had left all of my cash in the market, it would have been bad. So don't follow the 2007 Josh, follow the 2022 Josh.
It's interesting though, it goes to show you, even with a non-optimized strategy, with the right analysis, you can still make a ton of money.
Yeah, I call it luck. That's a nicer way of saying it. It was good analysis.
So we've talked about this when I've presented this before on YouTube. So let me clean this up just 1 second, because this will make it easier to be able to go and replicate this. So I need to make this stuff go away, because you don't need this. Just need this. All right. So what you really want to focus on here is not even the channels at this point, although we've used these in the past. I want to make these go away because I want to get down to something that's more tangible for everybody right now. So I'm going to leave this channel just for the brief moment, because this could wind up being support, and that would be somewhere around the 387, somewhere in there, depending on when we hit that, if we do or we don't. I'll make that go away, because what I really want to focus you on is just these 2 boxes, or 3, even though this is one and the same. This right here is the Federal Reserve announcement, whenever, back in July, a month ago, whatever it was, somewhere in there, back over here. This is Jackson Hole's. Now, I've talked about this in the past, where I tell y'all, if you treat this box like an opening range, take the whole day in market, and then above it, well, you're thinking potentially bullish or lifting higher. Below it, you're thinking bearish or going lower. And inside of it, you're thinking more of a neutrality. Well, if you go back and look at your retracement, oh, Josh is going to love this part.
Oh, come on, do it. So good.
50%, Federal Reserve announcement, Jackson Hole, what was your target? Okay, so it's somewhere into that level. Now, realize when Jackson Hole comes out, this is that day, whatever it is, that morning right there. So if you look at the reactionary bar, I'm using a 60-minute. If you look over here, you're looking at the last couple hours. So while this is a printed piece or whatever, this is a singular day. You'll know when those days are going to happen. The more important piece of this is it gives you guys a simple way to buy us. And I've said this to everybody that works in interactions, heard this 100 times already. The Federal Reserve is the world's largest hedge fund. They control the screws that control the flow or lack of flow of money. That's why our body hinges to it so hard. That's why they care about what comes out at Jackson Hole, or if Powell's ever going to speak. You want to mimic the biggest money player in the world, I just showed you what to do all on YouTube today. And I've said this before, and I'm saying it to all of you again. And yet I will say this, and 99% of people are going to ignore me on it. And yet I'm showing you where the largest money player in the world and exactly how to get a sense of where they are and how Wall Street is going to react to that with just simply a rectangular box. And it's quite powerful when you think about it, because once that day's in place, just like a set of fibs, you know where the middle of your fib is, or some place on the Fibonacci, or any other concept you use that puts a place across the screen that basically gives you a bullish bearish line, if you will. It's that simple. And most people, listen to me, they'll see this, man, that makes so much sense, and they will not do anything with it down the road. And then you wonder, and I say this not negatively, but it's like, even for me, it's like, oh, it's like today's the day, don't ignore it, because they're going to bias around it. The smartest institutions are looking at the headlines, then they put the position on, oh, it can't keep going lower. Well, maybe. I mean, you can come in and figure out, if you just take a basic, trend line off of this, it's not hard to figure out this thing is stacking itself down. So I bring this up to try to help everybody understand some of the simple logics that are out there, but don't ignore the Fed. They're telling you they're trying to destroy demand in the economy. They make it very clear. They've got Fed speak or Fed commentary from different people that have said where they think rates should get to before they're happy with it. The market knows they've taken away the punch bowl, and we'll see what happens from there. But that's a simple way for you all to reference something in that day or weeks later when they come back to it, and it can be really powerful. Then you take your MACDs, your fibs, whatever else you're using, and then time some things. It gives you targets, it gives you solid support. If we come back up on this, where's resistance going to show up? Probably about the middle of what? That fib range. If we can get overextended and recover, you're still fighting the slope here, guys. You've basically J-hooked, sold down again. This is starting to dagger, if you will. It's a term I've taught for 2 decades in the public domain, but you're starting to dagger through this. And what happens after a dagger, depending on how this wants to play out a little bit, okay, this kind of, oops, wrong one. This is broadening out a little bit, something about like that. It's starting to cool and compress. You'll come out, usually pull back, and then they have to make the decision. Do we walk to the right and then go down again, or do we start to turn and go higher? So there's no question, guys, it's extended. Again, market's being pushed, and I say deliberately in certain ways. You have news flow that's assisting with it. The most bullish 6 months of the year are about 60 days out. You also have a midterm election coming up. Regardless, you sit on the political fence, it's going to impact the market. And I mean that as in, let's juice the market, make it look good going into the midterms, because it's usually good for the incumbent. I mean, this is the standard text, playbook that they're running right now.
Yeah, there's a dude that studies that. I forget his name off the top of my head, but that's a known published thing. It's interesting.
So these are things we're dealing with, but yeah, it's absolutely midterms and then your presidential cycle. So all that stuff plays out. If you're wondering what the market thinks of the outcome of that, if you have gridlock, Wall Street, if you don't know this, Wall Street loves gridlock, because that means nothing's happening, which means they can then do their forecasting without worrying, is the government going to do something disruptive to our business, our forecasting? Anybody runs a business who's ever had to forecast out your budget for 12 months? Well, if you're a large Fortune 500, you don't have to worry about DC getting in the way of whatever your plans were. If not, I mean, I personally know in the latter part of Q4 of last year, beginning of Q4 coming into it, multiple businesses, large scale companies that were not making plans on certain CapEx plays until after end of Q1, because they wanted to see what happened for a variety of reasons for the next 6 months before they made some CapEx expenditures. It makes a difference what happened in DC, because it impacts money. So people say, oh, I just trade, doesn't matter to me. It does matter, because if the S&P is 70% of your underlying movement to your stocks, again, market, sector, stock is the breakdown, the pyramid, right? Yeah, it matters, because if they're discounting for future issues, it's going to reflect in your stock. Well, if that's the case and you're short a position, it hopefully builds confidence in you to stay with your short a little longer. So I hope that helps, guys. I know it's a little bit much, but trying to deliver value.
To summarize the Fed boxes, do you look at them as a support and resistance zone? Essentially, it could be a magnet pulling price back to it. It could be also a magnet, opposite polarization pushing price away from it. Just looking at it as a zone,
like a trap door at times. Like it could be a trap door, it could be a steel wall, brick wall, whatever. The beauty of it
like
is
my abs.
Exactly. Did you did that ab commercial in the infomercial days in the 90s, didn't you? The beachbody.com. So
it was definitely the 90s.
Sororities, do something with them. So yes, this does create support resistance. Okay. And again, it gives you the ability to bias one side or the other of it. And again, if I was marking some of my chart and I want this, I'd type in Jackson Hole versus a Wednesday Federal Reserve announcement, right? So I just kind of know what the difference was in that situation there. Okay.
Oh my gosh. In Zoom, I just realized they can put little reactions in.
I just saw that. Like, where is that coming from?
Oh my gosh. This is my new favorite thing.
Sorties, do something with him. So, but yes, that's how I treat this. And the beauty of it is everybody can see these past couple of versions of this, of what's happened. Most people look at the Fed day and everybody's trying to trade the Fed day. I'm telling you, use that information and, look at it coming forward in time and see the value from it, because it will. And you and I went through this, I don't know, a few months ago, and you had marked it, and you go back and look at your chart, you'll see where it was ping-ponging between those, and you could see them targeting on the way down. If the Fed's the reason, they think of it like this. If the Fed's the reason they juiced it from here, and all of a sudden you fail, and you're right back. I mean, if you're failing the trend here, where do you think they go back to? Where was support? What was once support should be support. If not, it fails, becomes what? Future resistance. So any rally back up, where's the problem going to be here? Resistance should show back what? On that Fed day.
So here's an interesting question though. Is there an argument that could be made that you should use the bottom of that gap as the actual size of the larger box, or the one on the left?
No, I guess because I'm more of a purist, I'm going to use that actual day as the mark. And if I really want to drill down on Federal Reserve days, I would take the last 2 hours of the day, because they announce at 1 Central, and then Powell runs us, says what he's going to say to almost 3 o'clock. So I would take the last 2 hours if I really want to needle down. For people who are investors, I would use a day. And let me take it one step further. If you're an investor, I would mark that clearly, try to put it on your daily, then go to your weekly with that. But I would mark that week as a Fed week and just be mindful of that was a Federal Reserve week. Since the weekly close, most important data points on a chart, if not the most single important point. That being the case, those Fed weeks would definitely stand out in my head that I want to focus on. This all boils back to how your fractal of time you're going to trade off of. If you're more of an active day trader, you might care more about the hourly, that last couple hours. If you are a position swing, you might care more at the daily block. If you're an investor, maybe the day versus the week, just to get a sense of where things line up.
I was just thinking that price action currently would be almost perfect with that bottom of that gap.
What else do you guys see with that? But it just really quick, since you brought this up, is that not only do you have your head and shoulders, but do you not have an island reversal in the making here if they don't fill this back up pretty soon? Yeah, because you've got the gap there and there. And that's going to catch a lot of people. I won't be surprised to see somebody in mainstream financial press highlight this at some point coming up, like Fast Money or somebody like that. But that's potentially
there's a confirmed island reversal in August 17.
And you still have one up from here. So these things need to stand out for everybody, just so you don't lose sight of that. A lot of unfilled gaps too. I love it that we have them, because I know it's gonna give us targets going up and down both ways. And eventually we'll get out of this bigger range, guys. You're basically hanging out in the middle of this range, but you're eventually going to clear this big swing, that big stretch of momentum, and the market will get back to what it's supposed to do. Does that help?
Yeah, it's great. Chris, what are your thoughts?
Just zoomed out a little bit further, and I noticed that we are like sitting right at a support line right now, support and resistance right at like 391 and a half ish, 391.14. Yeah, basically where both of those reversed, and then we came down and tested them again once we broke out of there, and it became support, and now we're sitting right there again.
Yep.
So I think we're at an inflection point right now. I'd be curious to see what happens over the next few hours, both today and into tomorrow.
New inflows, new month, two of the weakest months of the year. You're back to where you broke out from. So when they talk about traction, as you Chris's highlights we've talked about. So it's just time to see if they do with it. The slope's too much. We go through a long weekend, see what they do with this, and then go to work on Tuesday next week and see how it plays out, and see what happens from there. I mean, we just had a new moon start here not long ago, and so.
Do either of you guys have opinions on going into a long weekend trading? Like, do you guys shut down your trades? Is it inconsequential to your strategy?
Chris, you go ahead.
It depends on what my portfolio is looking like going into it. Right now, I'm very, very low risk on all two of my trades that I have. So it's very much just not going to matter. But generally, if I'm going into a longer weekend, just because there is more risk, right? There's more opportunity for the market to move while I can't do anything about it. I will usually trim my positions back a bit. Right now, my positions are already trimmed back a bit, so I'm not going to change anything going into the weekend. But usually, yeah, if there's a long weekend, I'll take a little bit of risk off the table.
Chris, why? I'm asking this for everybody else. What is your logic in trimming the position back? What is it? A comfort thing for you? Is it a risk profile thing for you? Is it just history of learning why you do or don't want to do that? What's your underwriting for people listening to us as to why you typically?
Yeah, it's a little bit of both. I mean, since there's 3 days where the market's closed, right? There's an extra day where the S&P 500 can still be moving, but especially when I'm in options positions, I can't trade my positions while the market is closed. So I could wake up, Tuesday morning and everything has moved significantly from where it was on the close of Friday. And there was nothing I could do between now and then. So while I'm perfectly comfortable taking overnight risk and all that sort of thing, which is the same type of risk, the longer that gap is between when I stop being able to adjust my portfolio and when I can start again the next time the market opens, the longer that gap is, there's just more risk in between. So I tend to like to trim things down so that if something does go horribly wrong in those 3 days, it won't affect me as much.
And you have that decay factor to deal with as an option trader versus an equity trader. Just to highlight, I mean, I know you get that, but if anybody doesn't get that, his risk guys, I mean, and I'd rather let Chris talk to this, but you guys understand the Greeks. If something does go wrong, depending on how much time he's got, really can have a dramatic impact. You fair statement to say there, Chris, in your thought process.
So to that point, for those of you that are a little more advanced with option stuff, those of you that are familiar with trading credit spreads, one thing that I will like to do because of that extra day where the market can't move against you, I will actually like to sell options over extended breaks. So for example, I'll sell a weekly option that expires next Friday because there's essentially 3 free days of time decay before Tuesday. So that's something that I like to do. I probably won't do it this weekend just because we are at an inflection point. Don't really know what's going to happen. Maybe we'll see what price action looks like tomorrow, but that is something historically that I have done before that I like.
So shifting gears a little bit to what Josh has brought up with this, let's just add some statistics behind it. Normally, statistically, markets tend to move up into a long weekend. Holidays have a natural bullish effect. And you have new inflows for this month to boot with it. Where's the outlier of seasonality that we are in the weakest phase to the weaker months coming up? But statistically speaking, you can look at historical studies done on this, and you should not buy, sell, hold advice. I'm telling you what some of the algorithms show is you buy in front of that and you sell at end of the year or you sell next week, just so y'all know. Okay, that's the statistical side of this. The other piece, I guess I'll bring up while we're on this, as far as like for me personally, things like that. It depends on my expectation of a trade, how long, I'm planning on this working, where am I positioned, am I in the final tail of it, did I just start the position? So there's not a hard, fast rule for me with this. It all depends on what my expectations are, the framework and the time. But clearly day trades are cleared same day and things like that. But the statistical bias, I think they've measured this over like 60 years, and there are algorithms that will beat the market by just buying that and selling a certain point in the future. So there is that natural bias. I typically focus it more on the main holidays, the biggers, Christmas, Thanksgiving, 4th of July. But the data when it's done is really across the board. If it's a market holiday, you buy in front of it 1 to 2 days out, and the returns, they have the distributions on that afterwards. So something to think about, especially the market being overextended. I will tell you from some of the pros I deal with, there are times they don't like the exposure, especially if you have a more bearish market or a more negative geopolitical scenario going on where there's uncertainty. But as we all know, with risk comes reward. So it's a balancing act. If you are somebody who likes to take on that, I don't want to call it the gambler's mentality sometimes, but it's a spec play to call it that, versus this is your typical framework trade, that's okay too. I'm much more of a framer. I want to frame everything and I want to understand it before I put risk on. So I know my R's and my stops and all that. I don't want to just shoot from the hip, if you will.
I was curious while you're talking, Scott. There's a resource out there. It's called the Stock Traders Almanac.
Yep.
It's pretty cool. It's worth a buy. I think we had we're on public YouTube, so I won't say it, but I think you need to see it for what it is. But for the statistically minded people, this will be exciting for you. But anyway, I was looking up. This is from 2020. I haven't bought it the last 2 years. I should. It's interesting. But in 2020, September, leading up to that, so I doubt it changed in the last 2 years, but September was 12 out of 12 for worst month. So it was the worst month of the year. And then October, for all three, they tracked. Let me go back. That was for the Dow, the S&P, the NASDAQ, the Russell 1K, and the Russell. It was 11 out of 12 on the Russell 2K. So there you go. If you're trading, what's that? 2K is mid cap, right? And then October was Dow was number 7 out of 12. S&P was 7. NASDAQ was 9th. Russell's 1K was 7th, and Russell's 2K was 12. So I don't know if you can see on my camera. It's all shiny. You can't see it. But anyway, that's the Stock Traders Almanac. And then we start getting into, conversations about the Christmas rally and all that, going into November and December.
I want to show one thing before we get done that's just hit my mind, just help people with some perspective really quick. That just, you said that made me think of something that might be helpful for people. I hope that's it. So we've talked about counter range in the past, and you've all seen this. This is something I showed in the traction group recently. And we've done the whole free trainings on this in the past, the counter ranges. So you see we're coming back into supports, the top of the counter range on the S&P. You also notice if you take the year's high to the low, you can see your fib. So there it is on the S&P. Sorry, let me go back 1 second on this. With the S&P, if you'll notice where it stalled out, just look left of the counter range of last July, come across, and you'll see that nice little struggle. Here's the NASDAQ. Been the weakest of everybody in here, clearly getting out of hand, back inside the box a little bit. That's interesting. You'll see it really couldn't get back to its 50 fib of the decline this year. It's been the weakest. We know that. Here's the IWMs. They've come out of a dagger, popped out. They were the strongest, everybody, because that's where growth comes from. We're getting close to that box again. And then here's the Dow Industrials. Again, if you'll notice the alignment with the fib and then your July range right there, again, this is just taking that high and that low. You'll see where this is stalled out nicely. So that's a nice confluence. Low of a counter range from a year ago, and then a fib retracement. And then we're sitting right back on the box, another fib right there. It's a simple way to see things. Everybody can mark these on their charts manually if you so choose to. But it's interesting because we know we're stretched down. We know we've pulled back. We're overextended on a bunch of these. it's unsustainable slope, and you're coming right back into, as Chris mentioned a minute ago, we broke out from on a lot of this stuff. We're getting right back into the counter range bases on top of that, guys. So yeah, you want to pay attention, quick heads up. So that may help some of you beyond just looking at standard moving averages, realize where the institutions broke out from and have been very productive, and we're getting right back in those levels again. So we're getting that place where support should start to hopefully come into play, and then go from there. If not, we look for the middle of the counter range down through here. Okay.
How far do those counter ranges project infinitely into the future? Like the one that was back in 2020. So it probably would have been the July 2020 range, the yellow box.
Yeah, I can actually, with the code, I can actually pull those forward as well. But yeah, because institutions set them, I'm going to keep them marked. And the other thing with this, I look at this like the ball bouncing up the steps or down the steps. We've gone from climbing the stairs to, well, falling down. Now we're kind of stuck inside of this. It's the other reason I continue to look at how range bound we are, and I'm going to trade that effect for now. The strongest 6 months of the year start in November, guys. It's not uncommon to see September be a weak month. October gets the bad rap, but September is one of the weakest months, if not the weakest month. I can't remember that for certain. So we're having that shift. So we're coming in support a weak month, but a lot of times they've already taken it down into the weakest month. So do you expect it to try to keep going down at 90 degrees? It's just not reality unless you're going to crash the market. And if you do, well, the milk's out of the jug on the floor, clean it up and pick up your pieces and start looking how you want to buy the market at that point. Just keep it kind of binary for everybody. But yes, I do pull those forward. I don't always display it that way because I know it can get cluttered, but I always recognize over here looking left, if well, you can see it right there. There's the January right there. You just look right, you'll see that low, and you'll see that segment right there where it got boxed in. And so that helps bring in more support. We could look left, but because the institution set these levels, I know where to pay attention to. And I just look at that and bring it forward. And then you can add fibs or whatever tools you want to put on top of it.
I just had, in fact, I walked out of there to come to this show. I was working with the high school students this morning, and we got to the look left portion of Foundations of Trading. I was like, y'all, let me tell you about Scott Landers. He's like trading dynasty. If you ever meet him, ask for his autograph. So if some like 18-year-olds run up to you and say, can I have your autograph? You'll know where that came from.
You kill me, man. You're awesome.
80% of that was true.
If the people walk up.
All right, we're going to start the outro music here, guys. Watch this. We can fade it in. But we're right at the top of the hour here. It's your opportunity for parting shots. Scott, we'll start with you. We'll go to Chris and finish with me.
Have a blessed Labor Day weekend, guys. We'll see you in about a week.
You guys got a ton of value this episode, which I know you did because I did, and I get to talk to these guys every week. So make sure you like the video on YouTube so other people can find it as well. And make sure you subscribe to the channel to get notified every time we do this live. And just like Scott said, hope you guys have a fantastic weekend, and we'll see you guys next week.
Yeah, I appreciate being with you guys. Thank you for everybody who faithfully comes and shows up and comments and asks great questions. It truly is a pleasure being with y'all. Keep an eye out. We've got some exciting stuff coming up. There's a new course coming out on gaps that y'all are going to love. Check that out. Check out the Ultimate Trading Summit when it comes back around again. We'll see you guys same time, same place next week. Have a great day.